Hey everyone, we are going to dive into two main topic areas here. The first of which being banks, what they are, and the various types of common banks that you're going to see so that you're educated about what banks you may be possibly banking with on a personal banking basis, but also business banking or whatever it might be. And then we'll kind of end talking about various services that banks can provide for you so that you know exactly what sorts of things you can expect and get out of a bank that you are going to be working with in your future. So ultimately, we'll break it apart into these different components. We'll first of all spend some time just talking about what a bank is in general and how banks are functioning and being able to make a profit. And then we'll get into the various types of banks. We are not going to be able to talk about every single type of bank that exists. We'll talk about some of the more common ones and emphasize a few of them a little bit more than other ones that will just kind of surface over. I do want to spend time talking about retail banks and credit unions specifically because, for personal banking purposes, those are the more common options that Americans are probably going to explore. And so we'll stack them up against one another to see what sorts of similarities those banks have with one another, but then also what makes them distinct and help you understand those advantages and disadvantages that a retail bank might have over a credit union and vice versa. We'll then end just talking about the various services that a bank is going to provide and offer for us. So, to begin, just in this first section, just talking about banks in general. The goal that I just want to help you understand here really is just how banks profit and make their money. So I'm just going to draw a little diagram slash picture here to help us understand that. So let's just center ourselves right here with the bank, right? So there's the bank. So every bank, of course, is going to have money that is going to be coming into the bank. And then also, there's also money that's going to come out of a bank, right? So typically, the words that we use for money that's going into a bank is it's going to be some sort of a deposit or money that people are going to save or invest or whatever going into the bank, right? When the money comes out of the bank, it's going to be money that gets withdrawn. It might come out in the form of a loan or credit when money comes out of a bank, right? So obviously, I guess, there has to be some sort of a person or there needs to be some sort of a business who puts the money into the account. And then similarly, when the money gets borrowed or taken out, then it has to go to some sort of a business or person or government or whatever it might be as well, right? So, more commonly, when we are putting money into a bank, so if you're depositing money, the types of accounts that that's going to be able to go into that are deposit accounts are most often a checking account or some variety of a savings account. And there could be more things besides that, so just dots for other options. So what usually happens is when you put money into a checking account or a savings account, what the bank will do is you are going to earn interest, or the bank is going to pay you some interest just for putting money into the account. Typically, you might see like a tenth of a percent interest rate, and it could go up to like 1%, or maybe some of them might go up to 2%. But that's usually for like a certificate of deposit or something like that, where have a large amount of money and hold it there for a long amount of time. But usually it's less than a percent of interest that you're going to earn. The reason why that is it kind of attracts customers to the bank because then it's like, oh, hey, I'm going to get free money just for putting money into the bank. But ultimately, that money that you put into the bank actually gets used to fund the loans and credit that people take out from the bank. So when money goes out of the bank and it gets borrowed in the form of a loan, that might go for like a personal loan or mortgages where people are borrowing money to pay for a house. It might be an auto loan. Money going out of an ATM, like any of those sorts of things where money is going out, those sorts of things are going to usually get charged interest. And so when you get charge interest on these sorts of things, these interest rates are going to be much higher. So it could be like 2%, or it could be 6%, or something like that. So when it's much higher like that, the bank's going to be able to make a lot more money there by charging interest than they are paying you in interest on checking and savings. And so that's really ultimately how banks are going to work and make money. So basically, in summary, when you put money into a bank, the bank uses your money to loan out to other people when they take out a loan. And then those people, when they pay back the loan, they pay back not only the amount of the loan, but they have to pay back all of the interest they get charged on the loan. And because those interest rates are so much higher on loans, the bank ends up profiting so much more off of that. And that's how the banks can make their profit and pay their employees and operate and all that sort of stuff. So that's basically how banks operate. All right, so we'll move into the second section right here, where there are different types of banks. I have 13 different types of banks that are listed right here. We'll briefly talk about each of the 13, but I do want to spend time on just a few of them because they're kind of the more common ones that you should know about in terms of personal banking. So the first one that I have listed on here is that of a retail bank, which I do want to spend time talking about. So some of the main things that you should know about a retail bank is that a retail bank really can serve people and it can serve businesses. But I'm going to kind of probably emphasize people because typically that's where most retail banks are going to serve, is they're going to serve personal banking services for individuals and families and that sort of stuff. But retail banks can also serve the banking needs of businesses. So convenience stores and schools and other sorts of organizations can also bank with retail banks. Some examples of some common retail banks that you may be familiar with would be things like Wells Fargo is an example of a retail bank. Bank of America is another common one. Think of like TCF Financial. Remember that the Gopher Stadium in Minneapolis used to be called TCF Bank Stadium, right? But now it's called Huntington Bank. And so Huntington Bank is also an example of a retail bank. Another big bank that's also headquartered in Minneapolis is US Bank. And the list can go on. So those are just examples of banks that are retail banks. When you bank at a retail bank, it's important that you recognize that you are a customer at the bank. And I'm going to put that in quotations, and I'll explain what I mean by customer a little bit later on when we start talking about credit unions. But basically, as a customer, you're just kind of, you don't really have any stake in the bank, and it'll make more sense in a little bit. So we'll come back to that. You should know that the bank itself is owned by an investor or investors. So the people that bank at the bank have no ownership over the bank. It's just owned by people that are investors and that sort of thing. These sorts of banks are for profit, which means that their purpose is to try to make money. They want to make more money by, giving out loans and that sort of stuff and seek a profit out of that. Retail banks are going to be what we call FDIC insured. And that's a really important thing that you should know about. So FDIC, what that stands for is it stands for the Federal Insurance. Oh, we'll come back for that. We need deposit first of all. It's Deposit Insurance Corporation. So that's actually through the government, the Federal Deposit Insurance Corporation. What that really means is it means that you have $250,000 per account, per bank, per person that is insured. So if your bank would happen to say just go bankrupt and close down, then up to $250,000 in an account is insured by the federal government. So you wouldn't want to ever then put in, say, $300,000 into a single account. Because if you had $300,000 in that account and then your bank closed down all of a sudden, you would only be able to get $250,000 from that account back to you because it's insured by the government, and you'd lose that other $50,000 of the $300,000 total. So, what I'd recommend and what you should do is you could put it in another separate account at the bank. You can talk to your bank about that just to make sure that that it would be backed up in case things went haywire or whatever. And you can put money in different banks. You could put $250,000 in an account to this bank and $250,000 in another bank, that sort of thing. But that's just an important thing that you should know about banking at a retail bank, that you probably shouldn't put more than $250,000 into a single account. All right, progressing forward, a commercial bank. If you think about commercial, like if I put the word commercial before real estate, we know that real estate is like land that you're trying to sell, but commercial real estate would be different than, say, like residential real estate, because if it's residential, you're going to reside in it. So this would be like, housing and apartments and stuff. So what commercial real estate is really meant for businesses. And so based on that, commercial banks are really meant to serve businesses primarily. There are other names that people might call commercial banks. So commercial banks can also be known as corporate banks, serving small, medium, large size corporations. So also known as a corporate bank. In terms of the stuff they do, I mean, they do the same thing as they would for personal banking services. They might be able to offer like larger loans and that sort of stuff. Typically, you're going to see probably much higher fees than you would at a retail bank per se, and perhaps different sorts of interest rates on loans and that sort of stuff. But yeah, just basically, if anybody ever says a commercial bank, you should know that it's just a bank that's going to be able to serve different businesses and organizations and such. An investment bank is something that's really deals more with companies as well. I mean, there are purposes for personal banking services, in which might deal with an investment bank as well. I just want to delineate maybe a few of the things that investment banks might be able to do for you. So they do help with either mergers of companies. So like if two cell phone companies were to merge together with one another, they would help with that sort of thing. Or if there was to be an acquisition of a company, so like if a company bought out another company, investment banks would help out with those transitions in which companies are kind of blending together, or a company buys out another company, and they help with stuff like that. They also help to just manage your investments. So if you have money put into stocks or bonds, mutual funds, annuities, whatever, they'll help manage the investments for that. They also do help out with what we call IPOs. We'll talk more about that when we talk about stocks and stock markets later on. The IPO is an acronym that stands for your initial public offering, and that really is just when you first offer up money in the stock market for your company. So your company really goes public by offering up stock, and so they'll help with the transition of that. So investment banks is not something that just as an ordinary family or individual, you're probably going to deal with very much. It's more something that you would kind of see on a business aspect in the business world dealing with. All right, public banks. So public banks clearly would have to deal with the general public of the population that it's serving, of course, right? So a public bank is really going to be a bank that is going to be government controlled. So like the Bank of Germany or the Bank of Australia, Canada, those are some countries that have public banks. I'll just kind of note some examples. So Canada, Germany, Australia, there's a whole list of countries that have government-controlled banks. In the United States, we don't really have a a banking system that is government controlled because there really aren't any public banks in the United States. Well, I guess except for one. So there's only one public bank in the United States. And that bank happens to be the Bank of North Dakota. So the North Dakota government decided to establish their own state bank, and it is the only government controlled bank in the United States. There are no other public banks. So in America, we have a private banking system. So we rely on retail banks and credit unions and corporate banks and all that sort of stuff to operate our banking system. But there is that public bank there in North Dakota. So even though we don't really have any public banks in the United States besides the Bank of North Dakota, we do have a central bank. Ultimately, a central bank is going to serve a variety of purposes in terms of like regulating banks, setting interest rates, holding banks accountable, helping with the economy, regulate the economy, all that sort of stuff. So they have a lot of purposes. In the United States, the central bank for the United States is what we call the Federal Reserve. The Federal Reserve is headquartered in our nation's capital in Washington, D.C. But the Federal Reserve is divided up into 12 different districts. So that map that you're seeing right there shows you where each of those 12 different districts are. For us in Minnesota, we reside in District 9, which you can see consists of Montana, North Dakota, South Dakota, Minnesota, a portion of Wisconsin, and the Upper Peninsula of Michigan all fall in District 9. The headquarters for District 9 is actually in Minneapolis, so in Minnesota itself. Yeah, in terms of private banks, like every bank is a private bank in the United States, right? Like retail banks and credit unions, that sort of stuff. So when we talk about private banks in the United States, they're really just kind of banks for the wealthy. So like if you have like $1 million or more than that, you would deal with a private bank and they help you manage your investments and that sort of stuff. I'm not going to spend too much time talking or dealing with that. Cooperative banks are banks that kind of, besides just serving banking needs of people, they usually deal with helping out with communities that are underserved and that sort of thing. We'll kind of skip past that. I won't delineate anything about that too much. But a credit union, I definitely want to spend time talking about here. So when you're banking at a credit union, credit unions, they can serve people and they can also serve businesses, I suppose, too, but primarily they are going to serve businesses. So when I wrote in quotations for a retail bank earlier, I said that when you're at a retail bank, you're more of a customer. But at a credit union, you are referred to as a member. So what that really means and the power of that is that if you put money in a credit union, you are actually a co-owner of that credit union. So not only are you just a person who's a customer, but you actually are a part owner of the credit union. So everybody that puts like at least a penny into a credit union is a like cooperative, collaborative ownership of that credit union. So it's not owned by just a single investor or a group of investors. It's really just kind of a community in which you then have like voting rights to be able to vote in the board of directors and all that sort of stuff. So yeah, it's just a bank that's owned by its members. It's not owned by a group of investors or anything like that. So also, what makes credit unions a little bit different than a retail bank is they are not for profit. So they're not established to try to make money. They're just there to try to help out their members and their customers. And oftentimes there's kind of a community aspect in which they're trying to support the community that they serve as well. Credit unions are going to be insured for the deposits by the NCUA. So retail banks would be insured by the FDIC, which was the Federal Deposit Insurance Corporation. NCUA stands for the National, and then CU stands for Credit Union. Lines up nicely. And then the A stands for the administration. So the National Credit Union Administration will back up money in your deposit accounts, and it's the same thing as FDIC. That is like $250,000 per person per account, that sort of a thing. So you would not want to put more than that into a single account. You want to make sure that you divvy it up, so that if the credit union were to go bankrupt, that it would be backed up by the NCUA. Some things about a credit union that are a little bit different than a retail bank as well is that, just as a general tendency, is we're going to see that interest rates are going to be much higher for deposit accounts and lower for credit accounts or loans than the interest rates that we see at a retail bank. So the fact that this holds that the interest rates are higher for deposit accounts would be like checking accounts and savings accounts where you can store money. If the interest rates are higher, that's good for you because that's interest they're paying you. And then the fact that this holds at credit unions generally as well, that the interest rates are lower on credits and loans, so interest you're paying means that you're going to owe less in interest, which is also a good aspect for you. Okay, so understand that's a general tendency, so it's not going to hold in 100% of cases, but by and large, you're going to see an overall tendency that credit unions will offer better interest rates for you than retail banks. But obviously, do your research and find what's going to be best for you. A savings and loans institution really is meant to kind of help homeowners or help you establish home ownership. It's kind of the main purpose of a savings and loans institution. They're also known as thrifts. It's kind of a nickname that they're given. Really, they only do savings and loans accounts. They don't offer a lot of the other banking services that other banks offer. They used to be more common in the earlier part of the 1900s and before, but they've kind of really dwindled over history and that sort of thing. So right now you're probably only seeing about 500 of them in the United States. I actually don't believe there are any that are in Minnesota, but they do exist. So just a few things to kind of know about that. Online banks and neobanks are kind of synonymous. Some people might put some distinction between those couple of things, but ultimately, an online bank is going to be something with no actual structure or building, right? So there is no brick or mortar building which you can go to the bank. You just have to log online, and the bank just exists in the virtual world. One of the big advantages that people see out of online banks is a lot less fees, because if it's all operated online, the efficiencies of not having to pay as many employees and that sort of thing makes it nice for that bank, and so they can kind of charge lesser fees or lower interest rates and that sort of thing. But it's not always going to hold, right? But as I've said before, do your research. Challenger banks, I don't need to talk too much about. Community development banks and shadow banks, they're a little bit less regulated, which makes them a little bit more shady. We don't need to talk about them so much. So I'm just going to kind of scroll back through all of these banks that I've just highlighted and just help you understand some of the main takeaways that would be helpful for you in real life. Okay, so everything that I walked you through here about a retail bank, these are things that you really should know for real life about these characteristics of retail banks, some examples of them that is backed up. So that stuff right there is really, really important that you should know, not just for the class, but really for real life, right? Commercial banks really should know that they serve businesses, right? So if it's commercial or a corporate bank, they're going to provide loans and deposit accounts for businesses. Investment banks just know that they help with investments and things for corporations or maybe even wealthy individuals, right? A public bank has to serve an entire country or city or something, population, right? It's going to be controlled by the government. know that there aren't any public banks in the United States except for the Bank of North Dakota. In terms of central banks, a lot of countries and stuff have central banks. For the United States, you should know that the Federal Reserve is the central bank for the United States, and it's divvied up into 12 different Federal Reserve districts. Outside of that, you should know all of these characteristics about a credit union. And just a little bit, I will stack up retail banks up with credit unions to help you understand the differences and similarities between those two. So understanding those things is good. Outside of that, I think that's kind of the main sorts of things you should take away from all of that. All right, so as I said, I want to make sure that for personal banking purposes, so for individuals and families, the go-to banks that most Americans will go to for banking needs are retail banks and credit unions. So I want to make sure that we stack these two up with one another so that we understand the similarities and differences that these banks provide for us. So let's start with the similarities. So first of all, they are definitely going to provide pretty much, for the most part, the same sorts of services as one another. So when I say the services, they're all going to offer savings accounts. They're all going to offer loans. They're all going to offer debit cards. They're all going to offer whatever. They usually provide the same sorts of services for you, right? So now just to kind of highlight some of the differences here. So if I use the left circle to represent retail banks and then the right circle to represent credit union, let's kind of break things apart here. So retail banks are for-profit institutions, whereas credit unions are not for-profit, just meaning that retail banks are in it to try to make money, and credit unions really just need to break even. They just want to help out their customers, right? At a retail bank, you are referred to as a customer or a client at that bank, which means that you have no ownership because it's owned by a group of investors, right? Versus at a credit union, you're referred to as a member, which then implies that you are actually then not only just a customer, but you actually part own the bank, right? So recall that a retail bank is going to be owned by investors or an investor, and then a credit union is actually owned by the collective of its members. So all the people that do the banking with the credit union, those are the people that own, right? Yeah, and then in terms of interest rates, you're going to see that the interest rates is going to be lower for deposit accounts at retail banks, but then the interest rates are going to be higher for the deposit accounts at credit unions. So usually a little bit more advantageous at the credit unions. And then the interest rates are going to be much higher usually for loans and credits at a retail bank versus at a credit union, where you're going to see lower interest rates for the loans as well as for the credits. The last thing that I'll highlight here is that you have the FDIC versus the NCUA insurance that backs up $250,000 per account to insure the money that's in your accounts. So yeah, those are some of the big takeaways that you should understand about similarities and differences between retail banks and credit unions, and hopefully helps you think about some of the financial decisions that you'll be making in your future, of course. All right, the last thing to wrap everything up here is just to survey some of the services and things that banks are going to be able to provide and offer for you. So I've listed out 16 different sorts of things. I'm not going to talk about these in depth really so much, but there are a few that towards the end of here that I will highlight just a little bit. So number one, checking accounts. Banks will offer that. Number two, savings accounts. We will spend more time in depth to understand the types of savings accounts that are going to be available to you. So in depth in the future, we'll talk more about that. The same thing in loans. So once we get to the second unit, we will spend a lot of time talking about types of loans and how you're taking out a loan and all of that sort of stuff. ATMs are usually going to be offered at banks. I'll highlight right here what that acronym actually stands for. So it's an automated teller, right? So a teller is like a person that works at a bank and can help you out with things, and it's a machine. So automated teller machine is what an ATM stands for. which you can get money out or do deposits or whatever. Do a lot of things with ATMs nowadays. A lot of banks will offer you debit cards, which is money hooked directly to your checking or savings account. And then credit cards, where you're borrowing money if you use a credit card. Currency exchange services, so if you're going to change like Japanese yen to US dollars or something like that, where you're converting between different countries' currencies and that sort of thing, they can provide those sorts of services. They also can notarize documents if you need official notarization on different sorts of documents. A lot of banks will offer that. You can also do check cashing. So if somebody writes out a check to you, you can bring it to the bank and get it cashed there. Online banking services and mobile banking services, of course, is a predominant tool that Americans use nowadays in our very digital world. Also, something that is an acronym here would be when people are doing an electronic funds transfer. So an EFT is an electronic funds transfer. So this might be like if you have a direct deposit from your company that you work for a paycheck, so that just gets electronically deposited directly. So that's one way in which we see electronic funds transfer. A lot of banks offer those services nowadays, of course. Okay, so this last slide I do want to spend a little bit of time just kind of talking about a few of the things right here. So right here, a wire transfer is really just being able to send money electronically. There usually is some sort of a fee, like might be a $25 fee or something kind of actually pretty high to be able to send money electronically. It's a just secure network in which you can send money across the country or between different countries and that sort of thing. There's different networks, like SWIFT is an example of a network in which you can send monies electronically through a wire transfer. So that's what that is. So a money order and then a cashier's check are kind of two ways in which you can send a check to somebody, but it's a little bit more secure than just a personal check. So when you're dealing with a money order is really a prepaid check. And that's the same thing for a cashier's check too, is that it's also prepaid. So that's what makes these two different than just a normal ordinary personal check, is that these are prepaid. So if you wrote out just an ordinary check, that check might possibly bounce because the funds are not guaranteed. Versus a money order and a cashier's check, the funds are guaranteed. So these are a little bit more secure. But what makes a money order different than a cashier's check, though, is that for a money order, the payee line is blank. So what that means is that who the check is being written out to is going to be left blank, and it's up to you to write that person's name on that money order. If you don't, and then you lose the money order, like it blows in the wind in the parking lot and somebody else picks it up, they could write their own name on that money order and then go cash it, and then they get the money. So it's not as secure because of that aspect. So when you get a cashier's check, the payee line is filled in by the bank, and so that makes a cashier's check ultimately much more secure. Ultimately, the reasons why you'd want to get a money order or to get a cashier's check is because the money is guaranteed. It's usually for things where you need to do some sort of an initial deposit or a security deposit or a down payment for something. So like if you are buying an automobile or you're buying a house or something like that, things that cost a lot more, oftentimes the realtor or dealership or whoever wants to get a money order or a cashier's check from you to make sure that those funds are guaranteed. So you oftentimes will have to get one of those couple things. Know that a money order you can get at a variety of different places. So you can get money orders at places like a post office. You can go to a bank, but you can also go to like various convenience stores. Like you can go to Walmart, you can go to Cub Foods. A lot of different places will offer money orders. However, for a cashier's check, you can only get them at a bank. So you can't just go to any other ordinary place. The only place you can go to get a cashier's check is at a bank. And that's the most secure type of one because it's prepaid for. You can only get it at a bank. The bank is going to fill in the pay line for you. So most times when you have to do like a down payment for a house or something, the realtor will ask for a cashier's check. So you just have to go to the bank and give the bank the money to prepay for the check. And yeah. All right. We'll follow up more with money orders and cashier's checks and that sort of thing a little bit later on. The last thing is banks will oftentimes help advise you on your finances. So wealth management or financial advisement is often something that banks will offer to you of little charge or some charge or maybe even no charge sometimes to help you plan for retirement or help you out with taxes or whatever it might be. So those sorts of services can also be offered by banks.